The government is under pressure to fulfil its pledge to halve inflation by the end of the year.
So the man who knows everything is Liam Halligan, who's been predicting, our economics and business editor. I think as early as April you were predicting this is where interest rates were going to go, Liam.
Sure, and I was calling for interest rates to rise back in March 2021.
Yeah.
And Andrew Bailey was
Governor of the Bank of England,
dismissing such ideas as ridiculous, saying inflation's transitory, don't worry, old boy. But here we are. Let's have a look at some numbers, Andrew and Dawn. The basic problem we've got is that the UK still has high inflation. We are an inflation nation. Our inflation rate in April, it was 8.7%. That means in April, prices across a basket of goods were 8.7% more expensive than April 2022. And a lot of people would say that's a massive underestimate of reality. Food price inflation's up at 19%. Crikey. The Bank of England target, of course, is 2%. So we are way off beam. We're expecting an interest rate rise to 4.75% this coming Thursday. That's up from 4.5%. But it may be that the Bank of England's rate setters on the Monetary Policy Committee really go to town and push interest rates all the way up to 5%. That's up from just 0.1% during the pandemic. Massive increase. That will be the 13th interest rate rise in a row. What does that mean for mortgages? Well, of course, everyone's mortgage is different. You might have a fixed, you might have a variable, you might be on a 2-year deal. But the average 2-year fixed deal, as recently as June 2021, the interest rate on that was 1.91%. These are figures from the website Moneyfacts. Now look where they are. In February 2023, with inflation and interest rate rises, the average 2-year fix went up to 5.07. And now, Andrew and Dawn, as of today, the average 2-year fix has gone above 6%, 6.01. Wow. What does that mean? On the average mortgage, for the average family, with the average what we call loan to value, the amount of loan compared to the value of the house, it's $2,500 almost a year. That is massive. These are average numbers, right? These are average numbers. Now, if you think that the average income, right, is about 30 grand, so after tax it's quite a lot less, an extra $2,500 a year, that's the increase in your mortgage on average. At the moment, we aren't feeling this so much because fixed rate deals are only unwinding gradually. But if you think back, fixed rate deals are generally 5, 3 or 2 years. Think back 2 years, think back 3 years, think back 5 years. Interest rates were 1% or lower in terms of the Bank of England. Bank of England rates are now heading for 5.5%, 6%. They're already at 5.25%. So the incremental increase in mortgage costs is going to be absolutely huge. And I'm not here to scare people, but I am here to try and knock the media, frankly, out of its complacency. Forget about Boris. Forget about MPs warring. Forget about this nonsense. People want to know what's happening with their homes.
On my front page, the Daily Mail, bank told to wait before imposing another rate hike. We've been on this for a while now.
We have been on this for a while. And the reason people are saying that is because interest rate rises, as I've just tried to demonstrate, because the fixes haven't yet unwound. You know, 3/4 of mortgages are fixed, but of course those fixes end. And around 150,000 fixes a month have been ending over the last 3 or 4 months.
Wow.
So more and more households are getting drawn into these much higher interest rates.
What if we get a bigger drop in inflation than we expect?
Well, we've got an inflation number on Wednesday. It's a huge week for economics. It's a huge week for economics. You're going to be seeing a lot of me. On Wednesday, we've got the next inflation number, the inflation number for May. As I just said, it's 8.7% in April. Now, inflation in America is all the way down at 4%, right? Unless we see a really big drop, the Bank of England is not going to have the guts, frankly, to not raise interest rates. That's where we are.
Where do you think it will be, the inflation figure?
It's very difficult to say. I'm hearing through the grapevine that it may still start with an 8.
Oh, no.
Wow.
If it doesn't start with a 7, it will... at most, it will be a major disappointment. And this is because of ongoing energy price rises, even though wholesale energy prices have dropped hugely. Ongoing food price inflation, even though food wholesale prices have fallen dramatically. It seems to be a particularly British thing. It's nothing to do with Brexit. Germany, France, they've all got high food price inflation as well. But but they also subsidise their energy prices a lot more than we do. And France has got nuclear, of course, which meant it's largely escaped the worst of this energy crisis. The Americans have got shale, their energy prices are low. It's the combination in the UK of high food price inflation and high energy price inflation. We can't shake off this cost of living squeeze. And the more the cost of living squeeze is seen through the headline inflation rate, the more a Bank of England that has lacked credibility, frankly, lacked communication skills, is going to have to be seen to keep raising those interest rates.
This is probably a really stupid question, but is controlling inflation, is it a price worth paying by doing it in this way, by putting the interest rates up so much, so fast, and making homeowners suffer and ruining the housing market? Is it actually worth the payoff for the damage to the economy?
When the three of us were young journalists, right, in the 80s, the 90s, these are the debates we were having then. And now a whole new generation of politicians, journalists, homeowners are having to relearn these lessons. It's always difficult, this trade-off between inflation on the one hand and growth on the other. Look, when you have high inflation, you have no investment, okay? Companies are so worried about what's going to happen, their costs and all the rest of it, the cost of labour, that you end up getting both high inflation and low growth. That's why economists for a long time and most politicians say, look, we need to just squeeze this inflation out. The underlying question you've really put your finger on there, Dawn, is this. Are higher interest rates the best way to lower inflation? Now, I've been arguing for some weeks that the Bank of England should pause on these rate rises, and I still think they should pause on these rate rises because it takes so long for these to come through, and they've already done 12. We need to see what happens.
Especially with the fixed-rate mortgages.
Especially with the fixed-rate mortgages. The danger is, though, Dawn, nothing's easy in economics, especially when you're in a situation like this. The danger is, and it's a little bit complicated, so I'll break it down. If you don't raise interest rates, the pound will fall. Why is that? Because investors put money in the pound to take advantage of higher interest rates. If those interest rate rises don't come, they then sell the pound falls. So what, you may say? Well, when the pound falls, because we import so much into this country, we're the second biggest food importer in the world, right? That means the cost of those imports goes up. So if they hold rates, they're going to get inflation, and if they raise rates, they're going to cause even more mortgage pain. Central banking is not easy, but I do think the Bank of England have made a lot of mistakes.
That's Liam Halligan, who is our erudite business.
It's really cheered me up.
Now.